Welcome to The Explainer. Today, we're diving into a really fascinating and honestly, sometimes kind of scary part of the financial world, phantom profits. We're going to uncover what happens when the money a company says it's making isn't actually there.
Okay, so let's just jump right in with a question that honestly trips up even seasoned business owners. Imagine having to pay the IRS taxes on money that never ever hit your bank account. Sounds impossible, right? Well, it happens a lot more than you'd think.
And no, this isn't some spooky campfire story. It's a very real financial concept called phantom income. And it pops up in two totally different ways. One is, straight up criminal fraud. And the other, it's perfectly legal, but believe me, it can be just as painful if you're not ready for it.
First, let's tackle the obvious one, deliberate fraud. This is what we mean by cooking the books. It's when a company intentionally lies about its numbers to trick everyone, investors, banks, you name it.
The funny thing is, the way companies fake their profits is actually pretty simple when you break it down. You can either make up sales that never happened, you can hide or shrink your expenses, or you can just do a little bit of both to paint a completely fake picture of success.
And this is not just some small-time stuff. Take Xerox back in the late 90s. To cover up the fact that profits were tanking, they started booking all the revenue from their long-term leases on day one, instead of spreading it out over the years like they were supposed to. The result? A staggering $6.4 billion in phantom profit.
And the fallout from this? It's brutal. A company ends up paying real hard cash for taxes and employee bonuses, all based on profits that were completely made up. Sometimes they even pay out dividends they can't afford, which just drains their cash and can literally destroy the business.
But okay, phantom profits aren't always about someone in a back room committing a crime. So now, let's look at the other side of the coin, the perfectly legal ghosts that get created by just standard, everyday accounting rules. This is a perfect, real-world example from a Reddit user. You've got an online seller here who is totally confused. Their tax form, the 1099-K, shows a bigger income number than what they actually got to keep. And why? Because the form included all the sales tax the platform collected for them, money that technically passed through their name, but was never really theirs.
This kind of thing happens all the time in businesses called pass-through entities, think partnerships or LLCs. For tax reasons, the business's profits get allocated to the owners on paper. The IRS sees that as your income. But, and this is a huge but, that's a totally separate thing from whether the business actually distributes that cash to you.
Let's walk through it. Say a business with two partners makes $100,000 in profit. On paper, they're each allocated $50,000. But they're smart, they want to reinvest in the business, so they each only take a $30,000 cash distribution. Well, here's the kicker. The IRS doesn't care. They each still have to pay taxes on the full $50,000. That $20,000 gap? That's phantom income. It's taxable, but it's not in your wallet.
So you see the pattern here, right? Whether we're talking about criminal fraud or these legal accounting ghosts, it all comes from the same basic misunderstanding, not knowing the difference between revenue and actual cash. And this slide, right here, this is the whole ball game. Revenue is an accounting number. It's a measure of sales, the top line. But cash flow, that's the lifeblood. It's the actual money coming in and going out that lets you pay your bills, your employees, and your taxes. Never forget, a company can report record-breaking revenue and still go bankrupt because it ran out of cash. Okay, so now that we get the problem, how do you actually spot these phantoms out in the wild? Let's get into the toolkit.
Spotting this stuff isn't just for forensic accountants with fancy degrees, Anyone can learn to look for the red flags, and trust me, a lot of the time they're hiding in plain sight. First off, just look for things that feel off. A sudden massive spike in revenue with no explanation? Weird. A business that usually deals in credit suddenly reporting tons of cash sales? That's suspicious. Also keep an eye out for huge payments for vague consulting fees, or a tiny company with a payroll the size of a giant's.
And there's more. Be wary of strange loans, like zero-interest loans from mysterious sources. And here's one of the biggest red flags of all, a company that seems to defy the laws of financial gravity. It's losing money year after year, yet somehow it's still growing and expanding. How does that work? Of course, the pros have some serious firepower. This crazy-looking formula is for something called the Benesch M-score. It basically crunches a company's financial data and spits out a score that tells you the statistical odds that they're playing games with their numbers. So, From now on, whenever you see a headline about a company hitting record profits, I hope a little alarm bell goes off in your head. Because now you know to ask the most important question. It isn't just how much revenue did you make, it's yeah, but where's the cash? Understanding that difference, well, that's the key to seeing what's really going on.